All right, everybody, welcome. Trends with Friends. We have joining us today a special guest, Jeff Park. Jeff is at Bitwise, a Wall Street alum, a CFA brain. I don't know if people need CFAs anymore, and we can get into that. Now, he is one of my crypto Jedis, introduced to me by my friend Anthony Pompliano. Jeff, welcome. And
Thank you.
And of course, we have Michael Parekh, my co-host and partner in crime and the AI Whisperer.
Love it. Well, I think one of the big trends that has had strong secular tailwind for is the hyper financialization of the capital markets in ways that have created profound new opportunities for investors to find wealth creation engines, but one that might be slightly unconventional in the ways that there is no Econ 101 or how to do it dummies guide as to accessing it because it is so relatively new and fresh in the direction of the markets post the global financial crisis. I think that trend is ever accelerating. I think crypto is one version of that story, but the truth is that many things that are happening around the gamification of markets has already been in trend set by with regulatory blessing for many years now, as Howard, you've been following through in the ways that retail investors behave.
So let's just do a little personality stuff to get it out of the way and fun stuff. So, the main override of the show is what you just talked about today, so people get to know you a little bit. If
Sure.
your life was a movie, who's playing you, and is it a drama, a comedy, or an action flick?
Oh my gosh. Well, no one's asked me that before. The genre would have to be something like Parasite, which is a genre bending movie of horror and comedy and drama, because I think my life at this point is a mixture of all in the 4 years I've lived in crypto professionally.
You know,
And who would play me? That's a great question. I'll have to come back to you on that. But I think it has to be somebody in the context of personalities within the crypto Avengers that we know.
Okay, great. It could be yourself. What's your weirdest or most unexpected daily ritual?
A weirdest, man. Another good one. I have a little bit of an unusual ritual, though maybe some people actually follow through this as well, which is I have the Daily Stoic as a book that I read every day. It's something that I think I found as a way to find routine and peacefulness in the ways that helps you start your day with perspective on all the things that matters in life. I have a little journal that accompanies it, and it gives you a chance to opine on some of these questions about life philosophy for 15 minutes before you start your day alongside your coffee poisoning. So that's kind of like my daily ritual.
What's a hill
most don't know of?
I like it. I kind of do some version of that. What's a hill you'll die on, professionally or personally?
My hill that I would die on would be something like authenticity or bust. I genuinely believe authentic people are short in supply, especially with the rise of AI and all the ways that people are losing their creative voice. And I think that's the most important that's going to matter, both personally and professionally. So I believe very highly in that being the thing that matters for all aspects of your life. And I'll die on that hill any day.
I think it's the perfect answer. I know you so, and I've met you and read you, so I think it's the only way out of this right now. You know what? We could do a show on that, about how real time, how we went from 20 minutes delayed quotes on Yahoo Finance to Twitter in real time, which led to the creation of fake news and inauthenticity. Okay, so what's the one lesson you've learned the hard way but now swear by?
Man, what is the one lesson I learned the hard way? One lesson I learned the hard way is to always find a good balance in the professional endeavors with the personal. I think that's something all of us can get lost in, especially in the era where the line between the workplace and the homestead is blending, post-COVID especially, and especially ambitious, hardworking people might find different ways to compromise corners left and right here and there, little bit by bit. But over time, it catches up. And I think I've learned in my own hard way that there is a price to pay for that, that for me, thankfully, hasn't led to any permanent fixtures of damages, but one that I would swear by as a thing to refocus, reprioritize for all of us, and take a step back to opine on what's really, really, really important in your life. And as much as we all love crypto and investing and sharing stock tips, at the end of the day, all of that is probably moot if the foundation that you're living on is shaky. Always lead with the personal as your most important North Star.
I love it. If you knew Ozempic was safe and it fixed the worst thing, your worst habit, what would it fix? What would you take Ozempic for?
I would take Ozempic for Man, having a slightly higher tolerance for general human incompetence. I don't know if that's a fair thing to say, but I
I
have a
just
very
made
short.
up that question. I prefer to make up questions. I love that question. All right, finish this sentence. If I weren't doing what I do now, I'd probably be.
Oh man, I don't know what else I'd be doing. If I'm not doing crypto and investing, I would be living an agrarian life on the farmland, getting my hands dirty, being physically productive. I have a
Correct.
home upstate.
There'd be no internet. That's what you'd
Is
be
that
doing.
did you grow up on a farm, Jeff, or
No, I
what?
I didn't. I actually, this is, I think, the irony of it all. I only grew up in cities. I grew up in Seoul and
Okay,
now in New York,
beautiful
and
city.
there's a part
Seoul
of.
is amazing. My wife's going there in 2 weeks.
Oh, it's incredible, and it changes every year. It's one of the most dynamic places on earth, and I think as we just continue to live our lives in a certain office-centric, city-centric way, you just feel like you're losing touch with the earth. And so we have a home upstate, actually, 2 hours north of Manhattan, and it's my happiest place on earth because when I go there, I feel disconnected. It's in the middle of nowhere, 8 acres of total kind of just forest and trees, and you get your hands actually physically in the grounds to do stuff and build things, and it's a muscle that most of humanity has lost, but honestly, we need it back. So that's, I think, what I would try to overcompensate for the other way if I'm not doing things in Bryant Park in this office with you right now in New York City.
Love it. So you've talked. So now let's get into it with you, me, and Mike. You've talked about radical portfolio theory. In a world where authenticity matters, which makes it hard to gain attention, the key is wrapping authenticity because you can be authentic. The authentic people are dead, right? Like, you know how hard it is to be authentic because no one
Mm-hmm.
cares. Or I mean,
Mm-hmm.
it's hard to get. It's hard to find audience because authentic people are being crowded out by the algorithms. So that's just a state of being. It's never been a better time to be authentic, and it's never been a worse time to be authentic, depending on how you look at it, right?
Yeah, yeah,
Meaning
yeah.
it's even hard for me to find these people, right? Like, fool me once. So we don't have enough time. So you've talked about this radical portfolio theory, which is taking your authentic ideas and how you want to be authentic with a great phrase. And so, like, walk us through radical portfolio theory.
Absolutely. So, underpinning the radical portfolio theory, which is a way to imagine a new investment framework, is the radical portfolio manifesto, which at the core is what you're speaking to about the human condition and how it's ever changing. I think we generally, in the peaceful prosperity that we experience now in the United States and globally for many decades, have come to realize that there are certain muscles that have therefore been underdeveloped as a result. One of those is that we have now actually come to a point where we don't fundamentally challenge things that we take for facts as institutional truths and values. And when you do that, it is on one hand easy to think you know, but the reality is that it's even harder to unlearn those things that you thought was so common table stakes for the foundation of your knowledge. And so the core of the Radical Portfolio Manifesto is to really empower yourself to understand what it is that matters and be contrarian in the ability to navigate the world of misinformation and in aspects, the financial condition itself, which is actually being distorted by a lot of technical factors that historically were not the case in the way his book has shown what investing could look like. So the number one problem that I have sometimes with Warren Buffett's value investing theory and Benjamin Graham is once upon a time that might have been a normal way to invest and a thoughtful way to invest. But I have come to really believe at the core that the market no longer really operates with that as the singular anchor of value and prosperity. And therefore, we have to kind of venture out of our comfort zone and really figure out like what is happening in the world and re-anchor yourselves from that perspective. And so the undertone here ultimately is that there's one giant elephant in the room, which is that most of the global financial system today is actually one giant trade, which is the global carry machine. And the global carry machine actually correlates equities and interest rate much more tightly than it historically ever has. And if you believe that to be the case, then the traditional 60-40 of equities and bond is no longer the orthogonal combination of assets you might own for diversification purposes when there's a whole slew of other assets that you can own that may not have existed 20 years ago.
I think
Jeff, so
Mike, walk us through. So I'll just chime in and then let Mike. I got mad at this whole thing because 64 is a beautiful idea, right? It's very simple for
Yeah.
RIAs because this all comes down to who's selling it the most, and that's registered investment advisors who get paid 60 beeps, and it was like a perfect strategy, right? Like you're not going to get fired for buying, for selling IBM, and you're not, for owning IBM in the old days, and now you're not going to get fired as an RAA for being in a 60-40 portfolio. This is pre, this is pre GFC, Great Financial Crisis, and this is like pre-Bitcoin, let's say, and pre all the other stuff that degenerate economy has brought along, and zero interest rates and zero interest rates, Web 2, Web 3, Bitcoin, et cetera, et cetera. So, and for me, 60-40 died, slapped my forehead death when Tony Robbins and I don't know, 4 or 5 years ago came out and did a book. Tony Robbins, the guy who walks on coal and heals people in conferences, now did a financial book about 60-40. I'm like, oh my God, this has to be the top. Mike, where's your take on all this on 60-40 and like what we've heard so far about radical portfolio?
I just wanted to understand Jeff's thesis a little bit better. So you talked about the global carry. You're using certain terms that are obvious from a professional point of view. I understand it, but I just want to make sure my understanding is consistent with how you're talking about it for a general audience. So if you could just explain some of those terms that, 60-40 is a global carry machine, or the phrase you used. And then also in your paper, which everyone should read, by the way, it's terrific. It really makes you think. Terms like compliance versus resistance and so on, just to understand the framework. Because at a base level, the 60-40 is simply, hey, let's balance risk and reward. Short-term needs and long-term needs, obviously adjusted for your age. When I became a broker at Goldman Sachs in the my early 20s and early 1980s, that was the core thing, know your customer, what's there, the young, old, etc. So 60-40 is just a convenient way to structure that. The percentages could be different. And there's a lot of academic evidence that 60-40 generally kind of works. Yes, a lot of people are making carry trades and returns because they're selling financial advice. I got that. But I just want to understand your terminology. And we haven't gotten to the crux of your argument, which is that now it's stocks and crypto or Bitcoin. And to me, I just want to understand, because you're going from stocks, which traditionally been viewed risky, and bonds have been more safer over long term. But now with stocks and crypto, you're going risk and more risk, arguably, on an asset class that's less than 20, 25 years old, versus asset classes, stocks and bonds, that are hundreds of years old, potentially 1,000 if you go into the history of these things. So I'd really appreciate just understanding that a little bit better.
Yeah, absolutely. There's so many ways we can take it, but I will start by sharing my view on what the traditional 60-40 was meant to represent and how that might have changed even in the short few years that have existed in post GFC and really even post COVID, which is that bonds and equities coexist because there's a perception that bonds are safer than equities because of the nature of the investment asset, both from a volatility perspective, but also from a guaranteed outcome perspective, right? Ultimately, bonds are fixed income instruments. And embedded in that thesis is a marketplace behavior of how investors choose to allocate across cycles of economic booms and busts, in which growth can be correlated with equities and recessions might be correlated with outperformance of bonds, right? By the action of the central banks, in which one of the stimulus to help the economies out of recessions is to lower rates. So that's the kind of the underpinning of what we think about 60-40. One, it's a way to balance growth, and the other is to balance risk. The fundamental assumption there about growth is the thing that I think is changing a lot, which is maybe it's true in the past that the way we measure GDP, for example, where we think about it as a combination of consumption and investment and government expenditures and net exports, would have been the classical definition of an economy booming. But over time, there's been some distortion, I think, even amongst those numbers. I believe actually it was profound last year when we saw some language come out of the US Treasury Department specifically attacking that particular definition of GDP, where the G, the government expenditure, is actually becoming like a larger portion of how those GDP numbers are affected. And so If you take a step back, is it a little strange that government spending is actually correlated to how we measure growth if that number in itself doesn't really refer to productivity gains driven by something economic at the core? And that is, I think, the $1,000,000 question. And so much of, I think, the way the world is going with fiscal dominance is about this particular G, right? This unlimited spending or kind of manipulation of interest rates at levels that are not determined by market prices. And what does that effect have to stocks? And I think that correlation as a result is changing. And we've seen how 60/40 has recently broken over the last few years. It is absolutely the case that bonds and equities are now more correlated than ever has been. And there are windows in which that exact diversification you're seeking is no longer present, which in itself is not that much of a mystery because all prices are ultimately determined by market participants, right? There's a person who wants to buy something, there's a person who wants to sell something, and there's a clearing price. That's it. And the more we move away from a model where there are market clearing mechanisms for price discovery, then you're going to have these problematic things that are happening. So, take for example that before the global financial crisis, the balance sheet size of the Federal Reserve was about $870 billion, which at the time represented about 6% of GDP. Fast forward today, and if you assumed the balance sheet would grow at the same rate as GDP, it should be a little bit over $1.5 trillion or so. Well, guess what? It's not $1.5 trillion. It's actually nowhere near $1.5 trillion. It's $7 trillion. It's 4 times bigger than what it should be. It's actually 25% of GDP. There's a really important fundamental question here as to how did this happen? Why did this happen? And what does this impact have ultimately for interest rates in general and the relationship that it has with equities? And I think that's kind of the beginning of the exploration of the surface area for what the radical portfolio theory is ultimately enthusing for us to discover.
Oh, you're on mute. You're on mute.
I think the discussion that you're going through makes a lot of sense in terms of the last 20, 30 years. But recognize that fundamentally, if you look at global economies over a 1,000, 2,000 year period, until the 1830s specifically, global growth on average was 0.1% annually across all systems. That means it took 1,000 years to double. That is now at 2 or 3%. So when we talk about, it was 1.5 trillion, it's 8 trillion, you've got to look at relative to what? The growth. And growth is driven by technology. And today, for 30 years, I've been saying, my career in technology investing is a dress rehearsal for what's about to come with AI. And I've been doing a lot of work on AI AI is not something magical. It's just a bunch of little lots and lots of technologies that are unleashing new capabilities. And there are a lot of arguments being made by serious economists that growth as we know it, which is 2 or 3%, which has been most the case in the 20th century and now mostly in the 21st century, could accelerate. Numbers potentially as high as 10% or more, which I think, by the way, will take a lot longer than people think. But in a world where the growth is changing, all through the 20th, a 2.5, 3% rate, that meant that we doubled the GDP, to your point, every 25 years. And if you have acceleration on growth, then all of a sudden you need to rethink the questions about debt and all of those things. Forget the composition, government, private sector, etc. But I'm just trying to get into this thing because today's debates are too simplistic, 2 variables, growth and debt. The reality is it's so many other things. Even the 60/40 discussion, when I was being trained as an investment advisor way before the CFA in the 1980s, you knew as an advisor to institutions that your portfolio performance was not just risk and reward on stocks and bonds, it was currencies, it was asset classes, it was all these other variables that came into the equation. And what I'm getting at, it's very dangerous to take 20 years of history on new technology-driven investment vehicles and say, because of all of this, we can throw away the general propositions of stable portfolio analysis.
I don't think I'm throwing away the importance of having quantitative tools for portfolio theory and understanding the efficient frontier. I'm absolutely not dismissing that as a valuable technique. The question is, what are the underlying assets that can actually give you those degrees of freedom? And what I would tell you is that the underpinning of everything that is ever known throughout history is always going to come back to whether risk-free rate is actually risk-free. And if you don't assume that as the fundamental underpinning of the physics of monetary assets, then it's very hard to actually have a robust conversation as to what you can build on top of that, right? And this is why it's so important, because it is the case over 50 years and isn't the case for 20 years doesn't mean that somehow having a longer duration of period is more relevant. Actually, I disagree. I think recency is the most important thing. Recent history is actually the most important weighting of how to anticipate trends and how to anticipate what's going to happen next. And every corner of the world right now as to talking about whether US rates as sovereign credit worthiness as AAA is actually valuably recognized across the world is an uncomfortable conversation, but it is a worthwhile conversation that changes everything that you take for granted. And that's, I think, why it's important to consider other assets that financial advisors are not historically talking about as investment products or store of value that I think can be part of an investor's toolkit in accessing some true diversification.
Yeah, good answer from both of you, Mike. I mean, people just really need many ways to look at this. I call it the degenerate economy. Jeff smartly frames it in a more portfolio management approach. I'm just seeing this trend, as Jeff says. I think recent trends are more important than older trends just because I'm only going to have a 40, 50-year investment life. So who fucking cares what happened before I was alive? And so it's just fun to wrap this stuff in. For me, it was like I went out the window with 60/40 finally with Tony Robbins, Robinhood, and Coinbase, etc. Turned me on to. Didn't expect it to happen, but with interest rates and COVID, it becomes a degenerate economy. And Jeff's wrapping it under the radical thinking. So with radical thinking, you find Bitwise. Tell us just quickly what Bitwise is and why you love it.
Yeah, sure. So Bitwise is a US-based crypto asset management company founded about 8 years ago now. And we are most famous for our flagship investment product that we've offered, one of first of its kind, which is a top 10 market cap weighted exposure to crypto assets. And that is our flagship Bitwise 10 index fund. And then now, of course, we're most famously known for having the Bitcoin spot ETF as well. That has been a big success upon regulatory approval now close to 2 years ago. And today we manage over $10 billion of assets, which is a remarkable thing. When I share that with some people, they're surprised, one, because they didn't think crypto asset management could be at that scale for crypto native asset managers, and two, because there's an impression upon that number in which the moment has arrived for mainstream consumption and advisors, which is actually the primary moat of our business. We work with thousands of RIAs across the country to help them understand, access, and provide different conduits for their investors and clients to find crypto exposure as part of their investment mandate.
So you and I met finally in person at one of your conferences, and I heard Michael Saylor speak, and I guess he's kind of the first Bitcoin treasury company, would you call it?
I think that's totally fair.
Okay.
Yep.
So if he's the first Bitcoin treasury company, I came away from that going, damn, I mean, he's such a polished presentation. It felt like a religious revival. A couple things struck me. I quickly left the building just to get some air before I gave him all my money. And I'm Canadian conservative, 60 years old, and I'm like, if I believe everything he says, I'll just buy more Bitcoin. So tell me, forgetting how his worked, the guy just made it great. He's just created his own economy on top of Bitcoin. Why is this there? Why is now everybody doing a Bitcoin treasury? Does that make you excited, nervous? What do you read into it?
I'm very excited about this new era of the Bitcoin standard generally being adopted by corporates. And I think there will be some great outcomes. There will no doubt be some horrible outcomes. That is the history of most financial innovation. At the same time, I think it will really help people understand the opportunity cost of capital in ways that historically most have been refusing to admit, which is that most companies running a treasury operations is just a cost center, right? It's managing cash.
Yeah, I imagine Microsoft's hedge fund is bigger than most hedge funds in the world. Their cash management and their just managing
That's right.
the cash they have.
That's right. Yeah. I mean, Amazon alone, I think the last time I checked, hires hundreds of people running treasury operations for all the cash and receivables that they need to account for. And I'm not saying that that business is black and white being replaced by the Bitcoin standard. It's not that extreme, but at the core is recognizing Bitcoin for what it is, for what it could do for companies. So like first and foremost, Bitcoin is a volatile asset, right? And because it's volatile, it has the chance to provide a different kind of financial derivative on top of it that's useful for generally the capital markets that is otherwise challenging to create. So from the lens of a creditor, for example, when you have the ability to extend credit and you charge a spread above govies to compensate for default risk, the rates are going to be high because the company is likely to go bankrupt, and that becomes in itself a reflexive death spiral as to why you should or should not lend to those companies. But in MicroStrategy's case, the unique thing that's happening here is that because the stock is so volatile based on the asset that is Bitcoin, but not really anything about the actual creditworthiness of the company itself. It's just that the assets are volatile. You have a chance to price credit spreads using the volatility mechanism in a way that has not really been done before, right? And if you then, as a creditor, believe actually that Bitcoin also is worthwhile collateral that you can have upon the need for liquidation to which you feel like your default experience will not create a loss, then there's a certain LTV to which you're willing to engage in this behavior as well. So the chance to have very good collateral and high volatility generally does not happen in finance. That is actually in itself a unique arbitrage only Bitcoin can potentially bring. And from that perspective, what companies can do is they can actually borrow. You and I, as Bitcoin investors at the retail personal level, right, we can't really access corporate credit market. Everything we do is either going to be on a recourse basis, or maybe it's credit cards or whatever. It's not meant to be institutionalized, but companies can. Companies can do lots of things in the credit market. And I think this is just the beginning of understanding how to financialize Bitcoin across different risk preferences, that there's a bid for various capital market participants. And in the end, the TLDR here is we're pricing the Bitcoin yield curve. There are people who are going to come in with different abilities to anticipate what their attachment and detachment points would be for their risk and loss profile, that they're willing to engage in the participation of Bitcoin's general price trajectory. And we're just at the very early innings of, I think, having seen how that plays out. And the reason there are a lot of companies that are coming into place now is because this is ripe for some additional financial innovation where you can do things on corporate balance sheets that you generally can't do in an ETF or a closed-ended trust, or even on the personal accounts of Howard Lindzen and Jeff Park.
If you had $10,000 today to just put into Bitcoin with all the choices of how to invest it, assuming you didn't own any Bitcoin, what product do you choose? An ETF? Do you go direct and buy it and say you own it and put it on a ledger, or do you buy a treasury company? What would you do if it was like your mom that came to you and said that?
Great question. So this may actually, I can tie it back to the radical portfolio theory, is I've hypothetically imagined if there were two securities you could buy in the construct of a radical portfolio, that ideal two security portfolio would be 60% of a Bitcoin treasury security and 40% of Bitcoin.
And Bitcoin meaning own it direct, like buy it off an exchange
Yeah.
and put it on a
Yeah.
ledger. Yeah. Okay.
Yeah, own it directly. Yeah, because that's the movement at some level in wanting to be censorship resistant towards otherwise a system that is one that is in itself the risk vector in the most cynical sense. But, to be honest with you, for most people who are choosing kind of one thing to buy, I always recommend the Bitcoin ETF. And the reason I do that is because the nature of owning Bitcoin in the construct of its non-custodial format is a little bit scary. I don't really recommend it for a lot of people who are afraid of how they might lose that asset, because if you do lose it, you can never get it back. And there are people, trust me, as you have also seen, that lose Bitcoin and they can't get it back, and it's irreversible. And it is the danger and the privilege of actually living in a world that is non-custodial and self-sovereign and censorship resistant. Most humans actually are really bad at that. They actually do want guidance. They do want advisors, and they do want to have a phone they can call and say, hey, where did my money go? Help me get it back. And that's what the Bitcoin ETF actually does, right? You won't lose a Bitcoin ETF that's in your brokerage. It's not going to go anywhere. And that safety, I think, is worthwhile for most people.
One more question here on this subject. I'll let Mike ask a couple questions. All right, you're with my father-in-law, sorry, and he's 82, and every time I mention Bitcoin to him, he has Fox News on, and I say, hey, Leon, you should buy some Bitcoin. He gives me the reasons why he owns gold, which makes me, every time I do it, it forces me to buy Bitcoin. And it's been a good strategy for me. Say you had a minute with my father-in-law, and how do you tell a younger old person and explain Bitcoin in a way that just gets beyond just the pure cynicism?
Mm-hmm.
I mean, not that you should care, but like, what's your like 1 minute pitch on Bitcoin?
My 1 minute pitch is that if you don't own Bitcoin, you are short Bitcoin, which is the only asset that has truly outperformed every case of monetary debasement that you've ever seen is Bitcoin. And if you just hold the belief that monetary debasement is a trend and a trend that is unlikely to stop, whether you're a Republican or whether you're a Democrat, that's the one thing that seems to be unanimously agreed, which is that there will be continued printing, and not just by the United States, there will be continued printing across the entire world in this race to the bottom of global liquidity, then Bitcoin is a hedge. Bitcoin is one of the hedges that exist as a way to counteract that because of the very foundation of Bitcoin is built upon its scarcity. And ultimately, Bitcoin represents what I would call scarce liquidity, right? It's not enough to have abundant liquidity in a world where we're awash in it. You need something to offset that energy. And so I think that would be my short pitch.
Mike,
And I think most old people would
you had your
also.
minute. You had your minute. You don't get to go over. All right. So,
All
Mike,
right.
you have a minute to explain why you haven't bought Bitcoin and what would you, my father-in-law, who's now pitching gold, how would you explain not Bitcoin, but any alternative that you think and why?
Well, let me be clear. I'm not a Bitcoin bear. I've been
Yeah.
an owner of
No, I know
Bitcoin
that.
since it was less than $1 in size. So what I'm just saying, when you're talking about portfolio theories, radical or traditional or modern or old, ancient, we're talking about balancing risk reward over spectrum, like what I said earlier, the boring stuff.
Mhm.
And so I agree. Bitcoin has a place in the world of a global GDP of $120+ trillion. And so, yes, it's wonderful that we've seen this new technology-driven, amazing creation. Its promise is barely out the door in terms of blockchain and Ethereum and all these other things can be built. I agree with that. What I'm trying to say in the context of just saying, oh, it should be it's 50% Bitcoin, 100% Bitcoin. That is too much for me because the risk reward aspects of that asset class, even though they're terrific, technical marvel, they're too short. Can't, and if I'm sent as a fiduciary, I can't in good conscience say, hey, put it all in this one basket. And that's my issue. When you mentioned, I smiled when you said custody on Bitcoin is a big issue. I mean, there's more than anecdotal evidence around the world that bad guys are breaking into people's homes that know there's Bitcoin in ownership and literally asking them for the cold storage keys. Custody, there's no custody. Yeah, most of the time custody is wonderful if I'm at a brokerage firm. But I lived through 2008 when Lehman and Bear went under, and I had friends who just lost everything and couldn't get access to stuff. I was one of the largest part of my portfolio was Goldman Sachs. That almost went under. 120+ year, 140 back then year firm. The only reason it got saved was because Warren Buffett traded in his name and said, okay, I'll give you really atrociously priced preferred advantages to me and I'll bail you out. And that was the confidence that allowed Goldman to come back from the literal dead over a very specific period. There are no guarantees. There's no risk-free in this universe.
There you go. No risk
It's just
free.
relative risk.
I'll give this one because I know Mike's got to play the advocate here. I really like the explanation of if you're not long, you're short. The question is it 1% or 3% or 5%? Listen, it's a good explanation to grandpa say, listen, all right, you don't believe what you just shorted Bitcoin because the rest of your portfolio, if this recent trend goes on, means you're deflating yourself.
Mhm.
All right, very good, guys. What's the one thing that keeps you up at night, Jeff? Regarding all the, I believe we're now entered a frothy phase. Like it's hard to understand the derivatives of the derivatives, right? Like, so there's a limited amount of Bitcoin, and now everybody is figuring out a way to build on derivatives of this. What worries you?
That's absolutely right. I think what worries me is at some level, the path ahead for a lot of young people is that they have to live with this certain mental incongruence. They have to live with this barbell thinking approach that has a very real intellectual duality, in my opinion. Are you familiar with the Stockdale paradox, Howard? The Stockdale paradox is coined by the experience of one of the admirals during the Vietnam War. as a prisoner, and it's to commemorate how he survived through the years of pain and torture because he had this eternal hope and optimism. And the paradox here being that it's two things you have to live with to have that ability, which is you just have to confront the brutal truth that's ahead of you. You have to be very realistic about like the current situation that's bad, and there's some despair, but at the same time you have to have incredible optimism for the end game. And most people cannot have both, right? It's very hard to face those two truths together. And I think Bitcoin and Bitcoin Treasury companies in some ways challenge this notion too, because on one hand, you could believe very optimistically that the end game is a good outcome for the prosperity of Bitcoin, but there is some brutal truths ahead, which is that financial engineering does always lead to excess, and there can be problems around liquidity, and there can be problems around leverage. And so we just have to be very careful and mindful. You partner with the right stewards in the space that are able to do it in thoughtful constructs with transparency and avoid some of the pitfalls that are happening generally in the financial arena when it has leverage in the system.
Yeah, very good conversation, gentlemen. Did I miss anything, Mike?
I just like to add Bitcoin Treasury. That's the current meme phrase right now.
Yeah.
You know, that's an oxymoron. It's jumbo shrimp. I mean, Treasury is one thing, Bitcoin's the other one. I mean, the risk reward are utterly different.
You just don't like the name. I don't like it's, SPACs meet. It's just flavor, right? It's just Wall Street doing its thing. Figs trading above 100.
I've been part of Wall Street doing his thing. I know the meme. When there's a musical chair game, make as much money as. Why do you think every institution, including my alma mater, Goldman Sachs, is into Bitcoin right now? Because it's the place to mint money right now. It's awesome. I love it. But I'm just saying, look at it as a portfolio. When you add the word portfolio, then look at it as a balanced thing, and that's all I'm.
Absolutely. So Jeff, one more. Michael Saylor, what did everybody get wrong? Why is it taken? He's made other great calls in his life, Apple being one of them. What makes it so controversial? I just don't understand. I mean, he explains it very well. So what is it about him that is special, do you think?
I think it takes incredible amount of courage to be an iconoclast in corporate America. And most visionaries at different moments of that transitional period experience some kind of controversy along its path. And I think the challenge, especially with corporate treasuries adopting Bitcoin in general, is because historically it was the bad zombie companies that bought Bitcoin on their balance sheet because they had no choice. And that in itself creates some adverse optics as to the types of companies that would arise to buy Bitcoin. It almost makes it look like buying Bitcoin itself is the sin for a business gone bad. Mm-hmm. And I understand that. I understand why that might create some challenges for CFOs to really lean into a narrative that otherwise is paved by failing companies. But, this is very much the same story of retail. Those who bought Bitcoin early on either were really just interested in the technology, or some of them did buy Bitcoin because they thought it was going to represent something astronomical that they couldn't find access point elsewhere. And of course, now it's been normalized where anyone and everyone can buy Bitcoin without there being kind of a connotation of sin around it. I think that will happen for Bitcoin treasury companies too. And we're seeing already some legitimate companies considering Bitcoin adoption on their board governance and having conversations about it. It will take time, but once one company that's reputable and credible does it, the optics will completely change. And it wouldn't surprise me, for example, if 5 years later, Meta decided to buy Bitcoin, where Mark Zuckerberg clearly has spent a lot of time in the space already to understand what crypto can represent, not just for his business, but for his customers as well.
He's buying AI. He's buying AI like it's going out of style.
Who's this? Mm-hmm. Who's buying AI?
Mark Zuckerberg is buying AI like it's going out of style. So he could buy Bitcoin too.
Yes.
It's scarce.
Yeah.
The second one, step 2, you've bought Bitcoin. What is the second thing other than the ETF, like the Bitwise ETF? If you're just Jeff Park, what's the second thing that excites you outside Bitcoin and Bitcoin Treasury, etc.?
Oh man, I'm so pumped by the category of professional gambling as an income stream for most retail investors. That's another thing that I know can at times be controversial.
Probably should have gone right there because now I just got excited. But yeah, I'm with you there. So that'll be episode 2. And just quickly, why?
Look, we're entering a world where data itself is becoming the most important thing in ways to construct proprietary value, right? And so knowledge is power. Knowledge has always been power, and information is becoming commoditized, where things like Polymarket, where you can bet on outcomes from a monetary fashion in which anybody can have an edge by having information that is better understood. I mean, those are the things that ultimately are going to be resistant from the movement of AI and commoditizing data. It's just the same way I believe like everyone should learn how to professionally gamble because it helps them think about probabilistic outcomes much better than kind of definitive close-ended outcomes in a deterministic way. Like betting on outcomes, not just elections, but on all kinds of events is a wonderful thing for the human mind to experience some sense of power around the things that's proprietary to you. So I just believe in it deep in my heart that it's a category for income that many people should have access to, and hopefully find it to be a supplementary thing outside of your traditional, W-2.
I would say didn't even know what it was a year ago. So if you told me that I'd be banking a Wimbledon bet on Robinhood a year ago through Kalshi, I would have said, wait a minute, and so kudos. So this is why I agree with you. If, Bitcoin's not my number one thing, but what you just said, AI is my number one thing and how it affects my company Stocktwits and where we are in the information system. Well, first of all, great answer because I agree with you. I think Michael will more closely agree with this, right? Citadel said 20% of market and now is retail, right? Goldman's out talking about retail. Stocktwits, I've always known that, when you went from 20 minutes delayed Yahoo Finance to Twitter being zero, I went all in on Web 2 because I was the idiot on Yahoo Finance. And I'm like, wait a minute. I know I was an idiot, but at real time, I can actually take everything I've learned and participate, right? What we got with real time was fake real time, meaning once influence happens, the incentive to make up fake news in real time and grift became a headache. And that's where we're at now, where real time isn't even that beneficial because you've got to curate who you should follow on real time so it doesn't end up being Chamath or a hypester or the wrong information because it's not real time. So now we're in a post real time world combined with data and tools that give people not just the ability to understand that we're in a post real time world, so be careful about real time. And this is why it's so fascinating to me, Jeff, is because Stocktwits all of a sudden is better positioned than ever because real time is beautiful if it is truly real time. But in a post real time world, you might as well be 2 or 3 minutes behind because the people that know that are curating all the real time and fake real time news to give you better signal post real time. So it's like stuff that I've been thinking about. I call it the Maslow, whatever hierarchy of grift.
Maslow's hierarchy.
Well, I call it the Maslow hierarchy of grift, right? Because real time was so good that the best people at it decided to even cheat. Yeah, so we're in this fascinating world where retail actually is on the exact same playing field with more learning, with more data sets, with the wrappers around, everybody has kind of their own little Bloomberg at some level. And then what becomes important is how you curate what perception of real time. So and then obviously prediction markets to me are better than the DraftKings FanDuels because those two companies' incentive is to kick off whales, the winners, right? So all you're left with is losers. Like, well, who wants to just be at losers? So you have poker where if I sit at a table, probably I could get good, but I don't want to spend the time sitting and grinding. So poker's not for me. On the sports betting apps, I don't want to be sucked into parlay bets and have bad economics. Plus, I'm betting, I'm not even allowed to win at scale because they don't want me. In prediction markets, we have a whole new paradigm where whales will come into the market because of the way they're structured. They won't get kicked off, right? And the second thing is it's a better interface for all of this in a financial world. So I think yes, this variations of prediction markets are fascinating to me. Mike, have you thought about this at all?
Yeah, I just wanted to touch on the term professional gambling, right? Gambling is as old as humanity. When you add the word professional, recognize that there are very few professionals. There are decades of preparation. You're a CFA. Those are they can professionally gamble. They're professional investors. But most people in a gambling market, in a speculative market, any marketplace, are not professionals. And so know when you're not a professional and understand that and understand that you need to trust this diversification thing we're talking about. So look, I just want to make sure, because right now, in terms of when we talk about polymarket and all these, this underlying assumption when this is being sold as a thing, is that if more people are professionals, and they're not. And it's like the old term, you go into a room, figure out who the sucker is. And same thing, if I go to Vegas, I know who the sucker is. It's me. Whatever I'm going to put down, the house is generally going to win.
Yeah,
The
but
odds
you're
against
just
me.
you're right, but you're also you're now just playing the role for us of being the guy who's trying to be cynical. So we appreciate that. You know what we're talking about. What we're talking
No, I
about is
do. But the
the
assumption is most
on-ramp,
people
the
right now being
on-ramp of prediction markets is 100 times X the potential on-ramp of sports betting. Especially you walk into an arena and they're advertising sports betting everywhere, and the market's just not there. Versus
Howard,
prediction
being sold
markets, it's for everybody.
Howard, it's being sold as entertainment, and that's the thing. I mean, the Romans came up with bread and circus, right? The gladiator sports, it's to keep people happy. People want entertainment. It's so prediction market, the betting on that I can do in Robert. It's wonderful. I can do all that, but it's entertainment. So don't confuse entertainment with investment. That's my only point. Thank you.
Okay. Well, I call it speculation as entertainment. We live in a world of free time and technology, and this was inevitable and only going to get more. I mean, I got to be Jeff. Maybe I should play you in your movie.
I think that's the answer. Full circle. Full
Yeah,
circle.
yeah.
Nothing would make me more privileged for that opportunity, Howard. The next
Who's the ugly guy
rerun.
playing Jeff Park? I don't understand. All right, so
young Jackie Chan.
We ended up covering what the next thing a little bit, so we don't have to have you back again. But I'm very excited about where we are with Bitcoin, mainly because there remains, just like Apple shareholders and Google shareholders, skeptics, right? Like, so that's the opportunity. But I think the thing behind the thing is we wanted a meme coins, we wanted all this. The thing behind the things is prediction markets and probably stable coins, but for another conversation. All right, gentlemen, I appreciate it. Jeff, we'll have you back. And
thank you, Jeff.
And Michael, thanks for keeping it real.
Thank you.
We'll see everybody next week.